As I said, I think it has to be a combination of all of those things. And if you short on just one of those factors, I think it's extremely dangerous. So I've never once shorted on valuation alone, and I don't know how anyone would reliably do that over time and actually do well at it. It's just too difficult. Likewise, there are a lot of bad companies out there with bad products and their obsolescence risk and could well go away in the very near term, but a lot of them then tend to be priced for that. So there has to be a valuation component mixed into that. Generally, I want at least 4 or if not 5 of the following: bad valuation, bad balance sheet, bad management, deceptive accounting, and something happening in the industry or the macro environment that would lead me to believe that this is all going to come together in a giant train wreck in the relatively near term. And one of the hardest things to get right is you can find those opportunities from time to time, but unless there's something that's really going to act as the trigger and set the whole thing off, it's just, you can bump along. In a market like this, you can bump along for a year or 2 or 3 with your thesis otherwise playing out perfectly and still not only not make money, but actually lose quite a bit of money. You're not getting a meaningful rebate. If there's any sort of dividend to pay away, that's painful nowadays. Markets have gone up a lot. That's probably worked against you too. It can just be a very painful ride. So you really need to set, in my opinion, a very high bar for what a short opportunity looks like. And again, the best opportunities that I've found over time combined all those things. So kind of truly the inverse of what we talked about and what we're looking at for a great long-term value compounder that may be out of favor temporarily or a special situation. You're looking at the inverse, where there's something that's really going to threaten this company existentially in the next 6 or 12 months, combined with their financial accounting presenting just a completely distorted picture of reality, a management team that's out there talking out of both sides of their mouth, telling the world everything's fine when it's not, a regulatory or litigation outcome that's going to clearly imperil the company. The balance sheet is paramount, right? I mean, if you have tons of cash and no debt, you have a lot of options, and that's what you need to offset short selling pressure. And the other thing I would actually look for and add to the list is something that I generally try to avoid at all times is crowded shorts. If there's more than, a week or 2 to cover or 10% short interest, certainly more than 20% short interest, that can get really rocky and bad for the wrong reasons, right? I mean, we've seen a lot of those blow up, and then, okay, you've taken the mark-to-market hit. Maybe that's not the end of the world if you're still ultimately proved right, but it just extends the time horizon so much, and it decreases your return on your own capital and your own fund so much that it's just generally tough. I generally want the shorts that are the best ideas, or the shorts that I'm going to put in the book, to be very early and to be a little bit under the radar so that the whole world isn't already short this thing and the borrow's not already gone or the options aren't already bid, and to find an opportunity that presents a little bit more unusual risk reward. Again, the opportunity to find those before the market has found them and have a relatively near-term realization of that, it's tough. It's just very difficult.